Hello there, my name is Martin Henley. This is the Effective Marketing YouTube channel. And if you've spent a second here, you will know that I am on a mission to give you everything you need to be successful in your business through this channel. So historically, I would have told you everything I know, everything you need to be successful is sales and marketing. But we are taking a slight detour today, I think, because we are talking to a finance person. Because the other thing you need to be successful in your business is money. And I wish I'd known that when I started my business. So today's guest has finance experience going back to 2000, including 15 years at KPMG. She founded her own business, Spark Consultancy, in 2017. She is involved in a number of non-exec advisory and mentorship roles, including startup mentor and mentor at the Royal Academy of Engineering. She is author of the book Investor Ready, and she speaks about startup investment and creating corporate governance structures that support accelerated growth. Now, we might be interested in both of those, but I think what I'm most interested in today is the startup investment. Now, today's guest was thrown under the bus by Keten Makwana, who actually employs her as a non-exec in one of his businesses, 77. So I don't think there is any better recommendation than that, than somebody that you actually employ. Today's guest is Julie Barber. Good afternoon, Julie. How are you?
I'm good, thank you. Refreshed after a nice Easter weekend away. So
fantastic. And you've had a little spring clean of the office today already. So that's,
exactly.
You are achieving today. Cool. So thank you so much for being here. I'm really interested to have this conversation with you today because when I started my business in 2005, I thought my energy and my wit were going to be enough to see me through. But Lord, I wish I'd had some money to invest in my business. So I've never known anything about what it is that you do. So I'm really, really interested and excited to have this conversation with you today. I normally ask people if there's something quirky I can say about them in the introduction. But I already had 3 pages on you, so I didn't ask you that. Is there something quirky that you don't know that might get them interested in you as a person?
Quirky. I've got a horse that I compete in dressage. So I'm not always in an office. I'm often in yard boots and a big coat and dealing with silly dressage warm bloods that want to misbehave instead.
Dressage is the weirdest of horsey sport, isn't it? It's not about going fast. It's not about going high or long. Basically you're dancing on horses. Do you call it that? Is that what you call it?
Control and precision.
Control and
absolutely.
precision.
So yeah, and it's a lot about communication, your ability to communicate with the horse with the smallest aid possible.
Wow.
As well. So yeah, it's a mentally very interesting sport as well as physically.
Yes. Wow. Okay. Well, I think that qualifies you as quirky. Well done. People should be interested in you now. I had a customer, I can't remember his name, who was into dressage. He's in the Crawley area and he's got very white hair. I don't know how big the dressage world is. Is that enough for you to know?
No. There's thousands and thousands of us that do dressage all over the country. So
that's coming as news to me. I would have imagined there might be maybe 20 of you tops. Okay, cool. So as you know, there is a format here. It's a very loose kind of format. There's only 5 questions. So your specialist subject today is startup investment, startup funding. Maybe if it goes really well, you might come back in 3 or 4 or 5 or 6 months and you can talk to us about the corporate governance for accelerated growth, because that's kind of more the marketing theme that we would normally be more interested in. So the 5 questions then are: how are you qualified to talk to us about startup finance, startup investment? Who do you work with? How do you add value to their lives? What is your recommendation for people who want to get better at attracting startup investment or investment for their small business? What do you recommend people read? And who are you going to throw under the bus? Who can you introduce us to who might enjoy to have one of these conversations? So we'll start at the beginning. How are you qualified to talk to us about startup investment?
Sure. So I guess originally, there's no official qualifications for supporting companies in fundraising. As such, it's a very niche area, and it tends to come more from your own business experience. But I spent 20 years in financial services, did the full run between consultancy, regulators, and banks, and through that did a lot of strategic and innovation work. And also pitching myself. So I spent a lot of time pitching to corporate boards to get money out of them, got over 20 million out of corporate boards for various projects and programs that I was leading. Um, and so I understand what it takes to give people the confidence to give you money. And then through the innovation work that I was doing, we would have quite a few startups coming in to pitch. So I was on the other side of the fence, on the investor side of the fence. We'd have startups coming to pitch to large corporates, and we'd be turning them down and sending them away because they weren't ready. They didn't understand what it would take to to engage with an investor. They didn't understand what the investor would care about. So my frustration levels grew. So when I started Spark 4 years ago, originally we just started it as more corporate focused because that was my background, but continuing to work with us, continuing to have startups coming in and pitching for investment in various places, it became an increasing frustration that I decided to act on. So I took all of that corporate knowledge and then applied it to the startup world. And we've now been working with startups and scale-ups for the last 2.5 years, with about 70% of our clients going forward to raise investment successfully, and about 20% of those that that haven't raised, learning enough from working with us to understand that they've got some big things to fix. So they're not raising because they're not worth investing in. They've realized that they've got issues and they go off and fix those and then go back out and raise later on.
Okay, wow. I've got so many questions now. So the first thing, let me start writing things down, because the first thing is like, so quite often, I'm not particularly interested in paper qualifications. I'm not interested in certificates. I'm not really very interested or excited. And there's quite a tone of this going on in the world, I think. Like Seth Godin, the marketing guy, says, don't waste your time going to college. Gary Vaynerchuk says, don't waste your time going to college. And I don't know if the time I spent at university was a waste of time. I studied politics, and I kind of leant towards political philosophy, which is kind of like, I think now, like motivation, like how people have been motivated kind of forever. So it wasn't a complete waste of time. But I think there's things that so that probably undermines everything I'm going to say now. This is such an important thing. Like having funding for your business is such an important thing. There should be some kind of qualification or certification or something. Do you know what I mean? So people know where to go at least. And then when they've decided that they are going somewhere, know how somebody might actually be equipped to support them or not. Do you think that?
I don't know about a certification. Something I would particularly like to see more of though is education in schools and colleges, around entrepreneurship and around raising investment to support entrepreneurship as well. Because typically what we see is founders come to us and say, we're really good at what we do. We know how to solve the problem that we set the company up to fix. We know how to do that, but we don't have that skill set around raising investment. It's a completely empty area for us. We're really nervous about it. It feels like a giant step into the unknown. And that's because it's an educational gap. So it's never been tackled for them at in their basic schooling. And unless you happen to have gone and done an economics or an entrepreneurship degree, then you won't have covered it either. So it is a big knowledge gap for entrepreneurs, for sure. So I'd like to certainly see more education, whether it's something you'd certify in. I mean, it's such a broad church and there's so many different opinions about how you should approach things. I think it might be quite difficult to create a certification for founders, but education definitely.
Yeah, even if there was some kind of chartership, like an accountancy chartership or something like that, where you can say, okay, at least these people are paying a subscription every year, so which means they have to behave themselves or else they won't get to carry this badge anymore. Something like that
Yeah,
might be useful. Yeah,
yeah. I mean, definitely on the side that I guess there's two sides to it, isn't there? There's the founders who want to go out and raise investment themselves. They just need education.
yes,
The people like me on this side of the bench, when we're helping people to prepare, um, there's not really any direct kind of regulation, if you like, of helping people to work on their business plans or helping them to work on their pitch decks. There's no thing that you can really belong to on that side of things, which it would also be good to see some improvements on. I mean, if you go further than we do, if you do things like actually arranging funding and that kind of thing, then of course you get regulated by the FCA. But we don't step into that realm, so we're in a a little no man's land, if you like, where it's really just about expertise and credibility from that side of things. So yeah.
yeah, 100%. So the second thing that I want to touch on then is that, see, I think it's a little bit like marketing. Like I think, like you're talking about pitch decks. For me, this is a pitch, but the value proposition is different. The value proposition is about returns, all of those things.
Mm.
But I'm making in my mind now. I'm making comparisons with marketing, because, like you're saying, these founders don't know that they may not know that they need money to run their businesses. They don't know how to get that money necessarily, and it's a bit like that with marketing. Like people go into business because they make great donuts, and they don't actually, very rarely, actually twig that if they don't have customers, they don't have a business. And if they don't do sales and marketing, then they won't have customers. So there are
Yeah,
comparisons there.
definitely. I mean, we tend to find founders fall into one of two camps in a really broad generalization. They're either from a sales and marketing background and they've had a great idea, but now they're trying to find technical support to achieve that idea. So they're looking for the CTO type support, and that's where one of their gaps is. Or they're from the CTO, the tech side, and they're so enveloped in the product um, that they don't know how to do the sales and marketing side either. So they've got a gap on the sales and marketing side. So, but all of them, whether they land on the sales and marketing or the tech side, all of them don't have experience in raising funding. So that's a gap for wherever you land. That seems to be a
Yes.
gap for founders, certainly first time founders.
Okay. I think there's a third category, which was me. I was just completely stupid. I did. I'd worked in sales and marketing, so I decided I was going to run like a marketing company, because I'd always worked in sales, and we'd always had all the target and none of the budget, and marketing had all the budget and none of the target, I assumed, and so I called it a marketing company. And then, but what I didn't realize is that you need money. I did realize you needed money, but I didn't have very much. I did a personal development course, and they told us something about the universe will provide. And the penny dropped. I had like 3 credit cards in my pocket that I'd never touched. So I had like 15 grand's worth of credit. So the next day I'm like, okay, I'm in business. I've got 15 grand. That will sustain me for 6 months. And off I went. And I'm not joking. It was a very special kind of torture for the 9 years that I ran this company as a proper business, employing people, doing things, because I never had anything. Everything that came up was just like an enormous leap, like employing one person, employing another person, needing an office, needing a. Do you know what I mean? And it was like the long jump for the 9 years that I ran this business properly. I was just running and running and
Yeah.
running and hopping and skipping and jumping and doing all these things all day, every day, because I was so stupid as to not realize. No, I wasn't so stupid. What I tell people about marketing is it's an investment of time, energy, and money in essentially winning customers. That's what you do in marketing. And if you haven't got any money, then it's going to take up more time and energy. And if you have got money, then you can invest your time and energy in other parts of it. And I knew this, and I've told people this forever, and I lived this, but it's not what I did because I never had any money. Like basically, the business was a really poorly paid job for like 9 years, where I worked 14 hours a day, and yeah, so I'm an idiot. So I think you've got sales and marketing people, tech people, and complete idiots, and I'm in the idiot camp for sure.
I think it's. I mean, I think a lot of it comes down to environment, though. So if you start your business in an environment where you are surrounded by, SME business owners who've been going forever, and they started up a long time ago and they built gradually, and they've, all of that. That tends to be how you think you should grow a business. Whereas if you start a business within startup environment where you're surrounded by people who are going for equity investment and making giant leaps in revenue growth, it's a very different um, mental approach. It's a very different understanding of what's possible. So I think a lot of it can depend on where you come from as well, and who you're surrounded by.
Yes, and this has been a culture change. I don't know if it's been a culture change in the last 20 years, but it feels like I didn't know anything about it, so maybe it isn't a culture change. But where these tech startups now are on this track, and it's all about seeding one, seeding two, seeding three, whatever they go through that process, and it almost feels like that's their mission, much more than even being a traditional business that finds and wins and keeps customers profitably. They're
Yeah.
much more about finding and winning and keeping investment, I think.
Well, yeah, because the large majority of startups, and particularly all of the startups that are raising equity investment, are intending to build that company and then sell it within a set time frame. So generally, at least by the time they're a couple of years old, often from the day they start the business, they know when they want to sell it by. And so they're starting that business going, we know we'll need to raise this much and this much investment. We want to get it to this revenue level and this profitability level. And that is the point when we want to sell the business. And so we know that we can walk away with this much money out the back of it. So they see it as a life-changing exercise in creating wealth. By doing something that they happen to be really good at, and it's pretty good fun along the way. But it's a very contained exercise. They're not expecting to run this business for 20 or 30 years. Some might say, oh, we want to take it to IPO and then still stay with the business for, a longer period of time. But the large majority are looking for a trade sale at some point in the next few years. So they go into it with that mentality of, we're going to raise equity, and it's okay that we're raising equity because we'll be able to pay those investors back when we sell the company. And the investors are okay with that because they know that the time frame is relatively short. It's 5 to 8 years, and they'll get a return on their investment, hopefully, providing the company doesn't go bust, etc., on the way, because it is high risk.
Yes. And is this a new culture, or is this just something that I wasn't privy to previously?
It's certainly ramped up over the last 20 years. The accessibility to funding has increased massively. The kind of digital approach to business has made funding a lot more accessible. In the old days, it was very kind of who and it was very closed doors, and there weren't the number of VC funds that there are now. There's literally thousands of VC funds around the world now that are looking to invest money. I think there's also a maturity in wealth holders around the world who have realised that banks is not the best place to put your money quite often because the returns are so low. So they look for other opportunities. So they look at things like startup investment because the potential returns are much higher. It's also much riskier, but the returns are much higher. So because there are more people who want to invest in it, that allows either more angel investors to invest directly into companies or more VC funds to set up and take that money and invest it for them, on their behalf. So all of that's changed in the last 20 years. And you've also had the revolution of crowdfunding as well, which never previously existed at all, and has gradually come up and gained credibility and become a route for equity fundraising as well as just reward or donation based fundraising. So there has been a big change in the landscape, and now some of the time, you used to spend time with founders going, equity, like before I started, I guess, you'd spend time with founders going, equity investment is possible. Now you spend time with founders going, equity isn't the only route, because it's so ingrained now in startup founders. Oh, we must raise equity investment to grow the company. Well, not necessarily. Some companies can just use debt. Some companies can use completely different means to grow the company quickly. So equity isn't the only route, and it's really important to appreciate that.
Okay, and are you getting involved in other routes? Are you getting involved in crowdfunding, those kinds of things?
I mean, we do, if we think, I mean, crowdfunding can still be equity, but we do point people in the direction of crowdfunding where we think their company would suit crowdfunding. Um, if you've got a very easy to understand product or service, particularly that is a B2C type product or service as well, that people can buy and use themselves, they can touch and feel it. That tends to do quite well on crowdfunding. If you've got a very complex, deep tech, B2B proposition that you need a science degree to understand, it's probably not going to do all that well on crowdfunding because people don't understand what it is that you're trying to raise money for. So you've got to think about, is it the right route to go or not? And then, on some things like, you mentioned it at the start that I'm involved with 77 Ventures with Ketan. Through 77 Ventures, there's a real aim to direct people not just to equity, but also to debt and grant solutions that help them as well. So looking at a really blended approach to help founders find the money that they need.
Okay, so it sounds, are there more investments? Is this kind of investment more available than it has been previously?
Definitely. There's a lot of money in the market at the moment. That it's not necessarily going to more companies at the moment, but those who are raising successfully are raising bigger amounts as well. But when if you looked back, say 20 years at the number of very small, very early stage companies that were able to raise equity investment, the numbers would be tiny in comparison to the number that you see happening today. So it's definitely a growth industry, if you like, for raising equity investment.
Okay,
But
good.
you're also seeing more people starting their own businesses. So that's another driver for the growth of it, because again, 20 years ago, everyone kind of came out of school and went, I'm going to go and get a job because I've been told that's what I should do. I go and get a job. And very few people would start their own businesses. Whereas now the proportion of people coming out of school saying, I want to start my own business, in some surveys is saying it's almost equal to those who want to get a job. So that's a massive transition. So
Yeah.
you've got more people coming in, with more businesses being started, with more money being needed, more investors thinking it's a good idea to put money into startups as well. So it's a pretty healthy, growing space at the moment.
Cool. Well, that's good news. That's really good news. I saw a
Yeah,
stat recently. I can't remember if it has gone from 2 million small businesses 20 years ago to 6 million, or from 4 million 20 years ago to 6 million. But it's definitely either trebled or gone up by 50% in that time. You're shaking your head.
yeah.
Do you know what the number is?
I think it's the 2 to 6,
So it's
but
trebled in the last 20
from
years.
yeah, the and particularly in the last 2 years, um, whenever you have some kind of major upheaval like we've had with COVID, you see a huge amount of transition of people deciding to start businesses, because they've been made redundant from roles, from their traditional jobs, and they've gone, what shall I do instead? I'm going to start a business. So you see big feed outs from events like that. So if you look back at the financial crash in 2008, some of the biggest startups, or some of the biggest companies in the world today come from exactly that period of time where people went, we're going to do something different. So, like Airbnb came out of the 2008 crash, um, because those events drove a change for the founders.
Yeah, 100%. And I was saying that to this. I kind of missed the boat. I'm not really involved anymore. I just talk to people about stuff now rather than actually doing it. But I was saying to people about this particular crisis that we've just come through, hopefully, is that this is either the biggest opportunity you're ever going to have, or it's the biggest
Mm-hmm.
excuse you're ever going to have. It's either one of those. It's not somewhere in the middle. Because in 2008, I was ready. I was like in my business. I was standing up and I was telling everyone, leading the charge. But I'm not in that position anymore. Okay, so what we're interested in then, but let's come from the other way because you brought it up. So the third thing that you said that triggered me was about businesses not being investor ready. They can't
Yes.
enjoy getting that news.
No. No. I mean, it's companies spend an awful lot of time making sure that they are customer ready, making sure that their products appeal to their customers, that they're able to cope with the customers that they bring on board, and all of those sorts of things. And they spend an awful lot of time doing that. And what they often forget is that investors are another kind of customer. They're still someone who's going to give you money to put into your business, whether they're exchanging that money for equity or they're exchanging it for goods as a customer. Investors are still customers, so you have to be able to attract those investor customers. You have to be able to make them aware of what you'll be able to achieve. You have to be able to convince them of your credibility. You have to be able to answer their questions, go through the legal process, all of those things. And if you can't, then you're not investor ready. You're not ready to go to market for investment, in the same way that if you didn't do that work around your product or your service, you wouldn't be ready to go to market for your sales customers.
Oh,
Um,
okay, cool. So this is the way that I can understand this. It seems to me like this is just a pitch, like a different value prop. So to like you're talking about investor customers, I can understand it like this. So they will be looking for a certain value, like your regular customers are looking for a certain value. They buy this thing, they use this thing, it's good. They tell their mates, blah blah blah. An investor is looking for a different kind of value, which is assumedly, is assumedly a word? Did I just make a word? Which is supposedly a return on investment. They're making a much
yeah,
larger investment. You need much better credibility. So it's almost like you're marketing and selling on two fronts, to the customer and to the investor. And I'm really
absolutely.
and I'm really interested in this because you said it. You said businesses are too busy doing the customer facing thing and not doing the investor thing. So my question is, surely, if they're looking for a return on investment, that depends on the success of the business, which depends on their success in not finding, I'm not allowed to say finding because Barnaby tells me off, attracting, winning, keeping customers. that should be what success is. The more of that they do, the more sales there'll be, the more turnover, the more profit, the more return for the investors. Unless, which is what I suspect, is that isn't necessarily the way you build value into a business for an investor, which is by serving your customers very well. Discuss.
So, of course, investors want to see that you're making great progress in the market and that you're attracting customers and you're getting revenue and you're even, hopefully getting profit. But for them to, all that they can see from your sales, if you like, is they can see history and they can see a snapshot of now. So they can go, today that company is able to sell 100K's worth of its product per year, and up until now it's kind of gradually grown. What investors are buying into is not history or now, they're buying into the future. So if you're going to sell the future to someone, you have to be able to paint a very clear picture of what that looks like. So part of being investor ready is being able to sell the future of how the company will perform. So to be able to do that, you need to have a very clear business strategy about what you're trying to achieve and where you're going to go and what milestones you're going to hit when. And you need to know what the financial model looks like for that. How much is it going to cost to achieve that? How much revenue are you going to get in each year? On what assumptions? What's credible? What isn't? You need to be able to show what the business plan is that says, how are you going to achieve those milestones that you've stuck down in your strategic plan? Because otherwise, why would we believe you could even achieve it in the first place if you don't know how you're going to do it? So that's why it's slightly different. It's not just the sales, because that's just now and history. It's the future that you're selling.
Okay, so this is, in the most positive sense, pure speculation on everyone's behalf.
Yeah.
Because I would say the less it's grounded in the now and the history, the more speculative it is.
Yeah, I mean, so you can, particularly with very early stage companies that are raising investment when they've been going for 6 months, there is no history. There's nothing you can base it on. It's completely speculative. But it doesn't mean that you can just make it up and write down any numbers you fancy. You've still got to figure out what would make those numbers credible. Is there other evidence in the market that you can rely on that says, companies of this type tend to perform like this. Companies with this kind of revenue model tend to bring on customers at this kind of rate. So you can use evidence from within the market to help predict the future of the company. Once you've been running a while, obviously you can say, for instance, a client that we worked with recently said, we want to put into our strategy that we will continue to double or triple revenue over the next 5 years, because we've been going for 4 years already, and that's exactly what we've done for that 4 years. So we've already proven our ability to double or triple in each year. So we want to continue on that journey. So it's not inconceivable to say to an investor, this company is capable of tripling revenue year on year, because they've already proven that they can do it at a smaller scale.
Yes. Okay, cool. Good. So it really is a pitch then. It really is just a pitch, because, all the time you're talking, I can't stop thinking about Dragon's Den, and I hate that program.
Me too.
I hate that program so much. Like, with the rich people sitting with their little piles of money judging poor. It just does my head in. And it seems to me their idea of what is investable is just absurd, and then they just throw money at the really cool person who walks in. Do you know what I mean? It's like, so for them it has to be completely original, it has to be unduplicable, and it has to be unduplicable. Is that a word? And then it has to be something else. There's no way so basically it has to be brand new, and there's no way anyone can copy you. There mustn't be any competition. That's not what happens in the real world. Do you know what I mean? If no one is making money in your market right now, I tell people that's not looking like a great market. You might be Apple, you might have tens of thousands of people queuing up to come and buy your products and services every day. That's a great position to be in if you want to launch brand new products. Every other situation isn't particularly cool, because from a marketing perspective, you're not marketing at that point, you're educating the world. Look, you have this problem, and we have this solution, and that is really expensive marketing, I think. So
Definitely. I mean, I think on Dragon's Den, you see a very small snapshot of the time that they spend with those people. They typically spend around 2 hours per pitch, actually hearing from the founders and digging into a lot more detail. And then the producers have their day of cutting out the bits that sound really exciting and what have you. And of course, it's incredibly hard. In a constantly evolving and innovating world, to be completely original in anything. But having said that, I think the thing that founders do have to be clear on is how they're different and better. So because there can be, let's say, there's 1,000 marketing companies out there. But why are you any different or better than the one next to you? Is it that your product is slightly better? Is it that you're niched into one particular market, so you're an expert in that area? What is it that makes you stand out from the crowd? Because if you're going to succeed to the extent that an investor's looking for, you've got to be able to step out and be above the rest of your market. So going into an empty market, like you said, can be really hard because you've got loads of education to do. But if you're in a busier market, then how do you stand out and be separate? That doesn't mean you have to be completely original, but it means that your take on it has to be original in some way. And actually, lots of the products that you'll see on Dragon's Den are not completely original. They're kids' clothing, or they're food, sources for food, or what have. There's always been sources for food. There's always been clothing for kids, but they have a unique and original way of approaching it, whether it's around the sustainability angle, whether it's around bringing a new food culture. They're bringing something new within that space, and that's what they're really looking for, is that thing that will attract the market to you.
yes, so that's like a marketing hook. You see, I have an issue with like unique selling points. I don't think there's 7 billion of us. There's nothing really unique anymore. And I talk much more about value propositions, because because this is what I think about innovation. If you're going to sell an innovation, you have to market it first. You have to educate the market as to why they need it, and that takes very deep pockets from a marketing perspective. So we don't have to talk about Dragon's Den anymore. But the question is, I really, really hate that. I really hate that. I had no idea. You see, the other thing, my frustration with that as a marketing person is, like, these businesses go on there, they don't seem to understand, but you might have answered this already, that this is a PR exercise. Like, you don't want these scumbags in your business with their piles of money. You've got 10 minutes on BBC One or BBC Two. That is worth probably the money that you're asking for, So, but people don't realise that opportunity. What I want to know is, how scientific a process is this investing in businesses? Because, so what I want to know probably is like the failure rates. Because you do see this on Dragon's Den, like they're grilling these poor people who are making every effort to know what everything costs and what they did in 1987 and what their actual margin, and all these very specific, very precise questions that people who are appearing on TV for the first and only time in their lives probably aren't going to remember. And then the dude walks in with dreadlocks and a guitar, and they throw money at him. Do you know what I mean? I understand that personality is the marketing hook. That's okay. but it does feel like a personality pitch. Like if you've got the personality, you maybe fare better than otherwise.
It definitely helps, and particularly in early stage companies, investors will always say that they invest in team first and business second. Someone had put a meme thing on LinkedIn just the other day saying, I'd rather invest in the A team with the B idea than the B team with the A idea, because it's about the ability of the team to attract customers, to attract other investors, to attract great talent to come and work in their company. And that comes from the capability and the charisma of the team. So that's always forefront, and then the business is secondary.
Right. But then you are only investing in this team for 5 to 8 years, and you're expecting
Yeah,
the band to split up.
yeah, exactly. So you're investing in their ability to move this vehicle from A to B. That's what you're investing in. So you're not investing in them for the rest of their lives. You're investing in them, in their abilities to say, we can take this company from here to here. That's what you
Right.
want from them.
Okay, good. Right. So of course we want to know what makes a business investor ready. That's what we're coming to. But just
Mm.
before we do that, because you said, I don't know, about 15 minutes ago, that the sales and marketing guy might have a great idea, or the technical person might have developed this, this amazing product, and their head's just buried in the product. I don't think either of those ways are great ways to develop products, personally. I think the best way to develop products is to understand the market and the needs and the size of the market, and to develop to those needs. But that doesn't seem to go on as much as I think it should. I think it should be like a virtuous circle where you talk to the market, they tell you what they need, you produce the thing, they love it, they enjoy it so much they come back every time they have another problem or another issue. And this is the way products should be
Mm.
developed. But the situation you're describing depends on a unicorn product. I learned this from one of these interviews. They all want to be tech unicorns. So it depends on this unicorn product that
Mm.
emerges from the brains of somebody technical, and just finds, huge markets and is hugely successful, and all of those things. Is it a little bit like that?
I mean, it can be. So obviously, like you said, the ideal is that people, understand issues in the market, go out and talk to the market, and then build based on what the market says and keep iterating from there. Um, but in reality, what you often find is that, founders will have perhaps been in a certain industry for a while, and there's a particular pain point that's pissed them off to the degree that they've decided to start a business to fix that pain point. So they feel that they know everything there is to know about that problem,
Yeah.
and they know how to fix it. So they're going to design the thing around how they would like to see it fixed. And when they've built it, then they'll go and ask some people if it's right, if what they've done does fix the problem for other people. So
Yes.
people can fall into this trap of being over invested in the product and not stepping back enough to engage with the market when they're building it.
Yeah. Well, I have very painful experience of working in businesses where they came up with unicorn products that everybody hated, and then they just blame it on sales and marketing because it's not selling. Do you know what I mean? That's probably the worst
Mm.
example. So you've got to have that flexibility, and that flexibility in your ego to take it to market and then hear what the market says and then evolve. I think maybe that's part of the personality. Right. So the big question, this is, well, maybe we can go to our question number two. So you've passed question number one. You are clearly qualified to talk to us about startup investment. Thank you for that. So question number two is, who do you work with and how do you add value to their lives? So are they customers of yours, or how does that relationship work? Because I can imagine it could get quite
Sure.
creative.
Yeah, so when it comes to, I mean, you've already kind of mentioned we do some other things like governance and strategic planning, but when it comes to preparation for fundraising, We work with companies that are typically in their first 5 to 6 years of life. They're either raising at pre-seed, at seed level, or at Series A, which means they're raising somewhere between 100k and 10 to 20 million. We only work with UK headquartered companies, and we only work with founders who have either previously run another business or have had some kind of corporate career where they've proved that they can execute as well. So we're interested in people who've got execution ability, if you like, as well. So that's a very clear profile that we've got of who we work with. And then where we add value in two different ways. So either we're adding value because the founders are saying, I know nothing about raising investment, help, I need a handhold through the entire process, in which case then we're educating them, helping them prepare the materials that they need to go out to raise investment. Or the second scenario is where we've perhaps got slightly more experienced founders who say, I know a bit about raising investment, but I'm too busy running the company to prepare all of this stuff, and we need to outsource some of it for help. So some of them will just come to us and say, can you help us prepare our investment materials? And so we add value in that way by being able to take on what they want to outsource.
Okay, so can you explain? Because I've never known. So it's pre-seed, seed,
C and Series A, yeah.
series. So there's only three levels.
No, those are the three levels that we work at. That's part of our niche that we focus on.
Okay.
So pre-seed is you've got an idea, but you've not built a product yet, and you've not got any revenue yet. So you're really right at the beginning, but you can raise investment at that stage. There's less investors that invest at that stage, but you can. Next level is seed, where you've probably built a product, you've got it into the market in some way, shape, or form. It could still be free at this point. You don't necessarily have revenue, but you have some kind of market traction where people are starting to use it and say that they like it. So you might be raising investment at seed, and typically, like, these are really generalized buckets, but if you're raising at pre-seed, you might be raising up to about 250k. If you're raising at the seed level because it's in the market and you've built the product, you're probably raising somewhere more between 250k to 2-3 million. And then at Series A, what you're saying is, I've bumped along the bottom, I've built the product, I've learned, I've grown it a little bit, I've kind of come off the bottom line, and now we're ready to put the foot on the accelerator because we've built a product that works, we've tested it in the market, we've got the back end ready of the business ready to scale as well. So now we just need to push more money through it, and that will cause the revenue to go straight up, basically. So at Series A, where you're raising anywhere between kind of 2 and 20 million, maybe more, quite often more sometimes, then what you're saying is, give us lots of money to invest in something that has proved its ability to operate in the market to a certain extent, and we can make it much bigger. So after Series A, and at Series A level as well, typically, like, as a ballpark, investors are saying we'd expect you to be at 1 million annual recurring revenue by the time you go for a Series A investment. Once you get past Series A, you can go Series B, C, D, E, F, up to about H or J, I think is the furthest I've heard. You don't have to do any of those. You could do just pre-seed and never take any more investment, or you could do 10 rounds of investment, and then you might sell the company, or you might go to IPO. But some of the WeWork that everyone's heard of, the co-working spaces, I think they got up to a Series H or something like that in their fundraising efforts, taking millions and billions more each time, because they needed that money to grow the company at the scale and the pace that they were looking to achieve.
Okay. Wow, you've opened a kind of can of worms there, I think. Did you know you were opening that can of worms?
No,
The-
but let's explore.
okay, so I've just Googled WeWork investment disaster. So I had intent in the search. How WeWork went from 47 billion valuation to bankruptcy is the first results. Oh no, why WeWork went wrong. So, wow. Let's talk about that if we've got time to talk about that. No, oh my God, I can't get it out of my head now. Right. So what? So there's styles of business famously that are more appropriate to investment than not. So, for example, this is what I've picked up from the ether. Service businesses typically not great investment vehicles because what happens is people decide to buy services from people they like and they like having around, and so it's largely based on those relationships. So if an investor comes in and those personalities go away, then the company doesn't have the value that it had previously, so they don't associate that value with they don't associate value with service businesses. I don't know. This is stuff somebody might have said in a chip shop when I was buying my chips one day.
So, I mean, it really depends on what kind of services those are. So, for instance, if you look at the explosion at the moment in the aesthetics industry, where people are getting their Botox and their fillers and their dermaplaning and all of those kinds of things, it's a service industry.
Yes.
But there are companies that are successfully raising investment because what they've been able to do is take the McDonald's approach
Yeah.
to aesthetics and say we can set up a base here, we can open another branch here, and it will have these roles within the branch, and this is exactly how we do each of the services. And the person who's going to that new branch in Hull has never heard of the founder in London, and they don't care that they've never heard of them. They just want to go to the branch that's down the road because it's convenient. So where service companies are able to productize what they do, then it can be investable as a service. And a lot of the big tech companies that gain investment are often what's called software as a service companies. So where they're not reliant on a person, but they're using, pure software as the service. So your Zero accounting software, your Canva image design software, your Monday.com project management, they're all software as a service. So they are services that are available in a productized way. And then you can still have equity investment into real products like beer, like Brewdog, has raised an awful lot of investment and they make beer. So there's lots of pure product things that you can get investment into as well.
Yes. So I suppose it depends then on to the extent that you can productize your service. So if you can
Yeah.
create a cookie cutter experience, like nobody goes to McDonald's for the romance of it, they go because they know exactly what they're going to get wherever they are in the world.
Yeah. It's the scalability of it. So can
Yes.
we repeat this successfully in multiple demographics or geographies?
Yes. And I suppose any business that is providing a service at scale must have done that, because they're
Yeah.
not getting the founder's attention. They're not. Okay,
Yeah,
good. So
exactly.
that answers that question. But still, I want to say that service businesses are less investable than product businesses.
Um, if they are personal service businesses, then they're trickier. If they are software service businesses, then they're totally way more investable than a product. Because
Yes.
if you look at Canva, for instance, or SurveyMonkey, their ability to expand globally is unlimited
Yes.
because all they require is the internet. They don't have to set up bricks and mortar bases or anything like that. So it's less about kind of product or service. It's more about ability to move geographically quickly. So if you don't have to set up bricks and mortar bases to work from, it's a lot cheaper and it's a lot faster to be able to grow really quick.
Yes.
Whereas if you've got to, if you've got to open another shop and another shop and another shop, it's slower and more expensive. So those, bricks and mortar attracts less investment than tech-enabled, digitally mobile companies.
Okay, cool. And so software is perfect. There's no supply chain. There's no storage. There's no, there's no stock. You just literally photocopy it and send it is what you do.
Yeah,
Cool.
that's the most scalable for sure is software.
Yes. And are there people who I'm getting a real sense at the moment that there's too many people with too much money, like with cryptocurrencies and NFTs and stuff. It's like, if you're buying an NFT, you are buying zeros and ones, is what you're buying, and that's lovely. I'm not, I'm happy for them to do that. But are there investors who are more interested in one thing rather than another thing? Are they more interested in, I don't know, startup service companies or startup retail companies or startup software companies, or is that the way it
Yeah,
works?
absolutely. So investors will specialize in particular areas that they have their own expertise in. So if you look at some of the biggest angel investors, so Chris Adelsbach, for instance, is he had a financial services company. He sold it for 500 million a few years ago, and now he just invests in financial technology companies. That's all he invests in is fintech, because it's what he knows, it's what he understands. He invests in fintech. That's it. And most angel investors will tend to invest within quite a narrow remit, because it's where they know that they understand what they're buying into, and it's where they know that they can also add value themselves. Yeah.
Okay, good. So we're getting a sense of what it is. So basically, what you need to do is build a really convincing forecast. Is what is what investors want to see, and have
Yeah.
some personalities, and then you're winning. Is it as simple as that?
At a very high level, yeah, at a very high level, having the great team, understanding what the gaps are and how to fill them, having the really credible forecast. Something that we say to our founders is, your forecast doesn't have to be right, it has to be credible. The universe isn't going to read your playbook and go, oh, we must make sure that revenue happens exactly as you predicted it 5 years ago. There's not one company in the world that can look back and say, we hit to the dollar, to the pound, exactly what we predicted in our financial model. It just doesn't happen. But it's not about it being perfectly right. It's about it being really credible. Because that gives investors confidence again in the team. The team have the ability to create credible forecasts for this company and to understand what it could achieve. So if you've got someone saying, "Oh, we've created a new brand of dog food and it's going to do 500 million in its first 3 years," most likely they're going to be met with, "I don't think so," because it's a crowded market. It's not a very easily scalable business because of manufacture and supply and all of those things. So an investor looking at that financial model for that business would be going, no. Whereas, if it's someone saying, well, we've created, a new ability for people working remotely to be able to communicate together, and we could get to 120 million in 3 years, possibly. So it's about, what's the credible possibility for this type of business in this market at this time.
Yeah, the only issue I have with that is that famously founders of businesses and business owners are marvelously optimistic when they think about what the future holds for their business. And so, really, what they probably need is a dose of pessimism. Or, so you said it doesn't have to be, what was the exact word? The forecast doesn't have to be, it has to be credible, it doesn't have to be, what was the,
Perfectly right. Yeah,
perfectly
it doesn't have.
right.
Yeah,
But can it be marvelously optimistic? Like, does it have to be? Could it be? Because I'm really quite good. I'm quite imaginative. I could come up with really, really compelling and credible forecasts for what might happen in the future. Um,
yeah. I
but
mean, but it's got to be within the bounds of credibility, within the bounds of possibility. So
right,
again, if you're saying no one else with this kind of company has ever done 500 million in 3 years, but we can. Well, why? What makes,
yes,
what evidence can you point to that says that you are completely different? Now, if the reason that you say that you can do it is because you've got this piece of technology that all the other companies in the market haven't got, and you are the first one to be able to deploy it, then maybe. And that's then down to the investor to decide how much they believe in what the technology is capable of achieving and whether they think that number is achievable with that technology. But
yes,
if you're going and saying, well, we can do 500 million, and no one else ever has before, and we can't really tell you why we can do it but no one else can,
yes.
then it's not a credible number.
So it has to be credulous. It has to be plausible.
Yeah,
Yes. Okay,
absolutely.
good. Because I like for every day I was running my business, it's like tomorrow this is all going to kick off and be great. And I've ran at 110 miles an hour every day, and it just never really was. It was always fine. It was never great, never anything like great. Um,
Mm.
so this is the thing then. So this brings us to this WeWork thing, because I think the issue was that this guy was just an incredibly um, charming man, and he took. I don't know if he took billions in investment. I don't know what he took,
Yeah, they did. They
but
did
he
take
took a lot.
billions in the end.
And it was basically, it came
Yeah.
down to the force of his personality, and apparently the whole thing was run like a cult. So this must be probably the best example ever of what you don't want to invest in, but how you want to go about getting investment at the same time. So I can't. They're talking about the guy not eating pork at the end of Pulp Fiction, and it's like, would you eat a pig? And it would have to be a pretty charming Emma effing pig. But this guy clearly was that. Um, so how do investors guard against that then? Getting carried away with these personalities, I wonder.
I mean, it, it is something that investors have got to be careful of, and there can be in the investment world there can be a lot of jumping on the bandwagon of, oh well, they've invested so I should invest, and the kind of group belief systems, if you like, that can result in, like you say, a kind of cultish approach to managing a company. um, but this is where strategy and governance comes in. So if you're going to invest in a company and you say, right, I want to see, say it's been running for 4 years, great. I want to see what your strategy has been over that time. How many of your milestones have you actually hit on time? Oh, none of them. Great. That's not, that doesn't really fill me with confidence that you can hit any of them in the future.
Yes.
So, and the board, like WeWork had a board. So despite the fact that um, their founder was very charming, their board had a legal responsibility to monitor the progress of that company against the goals that it set. And if it wasn't hitting those goals, they had the power as a board to remove the head of that company and put someone in who could run it.
Yes.
Now, without being able to be a fly on the wall inside those board meetings, something went wrong along the way because decisions continued to be made that put the company into a really bad position. And it happened with another, I've forgotten the name of another startup that went bust a couple of weeks ago. They'd had 150 million in investment, and they were hiring at incredible rates, ridiculous amounts of people coming on board, and then went bust like that. But they had a board, and the role of the board should have been to say, well, hang on, folks, we're getting a bit close to the wire with the cash here. Or, hang on, folks, the revenue's not coming in as we said. Why isn't that working? So as an investor, you need to be, looking at what past performance has happened, and seeing whether they're capable of executing on what they promise. If it's a very early stage company, like it's 6 months old, obviously you can't really tell that, but that's why very early stage investors don't put a lot of money in. They'll put 10 or 20 or maybe 50k in, but they won't risk a lot. They'll expect you to get a bit from quite a few different investors, so that the risk is spread amongst multiple investors.
Okay. So this seems to be like a recurring theme in these conversations. It's like people come up with a car analogy, like you have to pass a driving test before you get to run a business. And the thing about that is it seems to be what happens is when businesses start going wrong, not like when your car starts to go wrong, where you pull over and call someone who knows what they're doing. When a business starts going wrong, you put your pedal to the metal and you go hell for leather. Do you know what I mean? It's like all governance is what you would call it, goes out of the window. It's like we have to keep charging or else this is going to fail. So that seems to be a recurring theme. What I'm interested in to know is, like, what kind of return is an investor expecting? What is a reasonable return? And are they looking for reasonable returns or are they looking for unreasonable returns?
It's expectations on return have grown, particularly over the last 5 to 10 years. So you used to get people looking for a 4 to 5x return on their money and thinking that was pretty good going. Now you're looking at a 10x return as a minimum, and with a lot more, particularly VC funds, looking for a 60x or 100x return on what they're putting in. So they're not looking for the company that can grow to a nice size and return have a 10 or 20 million revenue.
You're getting another cup of tea delivered now.
I am, yeah. I'm very lucky.
Great service you've got going there.
Yeah. He knows I talk too much. I need liquid. They're looking for much higher returns. They're looking for as much as they can possibly get, because particularly when you look at venture capital funds, they invest in a wide portfolio of companies, because they know that the failure rate is high. So they know that 90% of very early stage fail, and then even more drop off as you go. So they need the return to be really high on some of those companies to cover the fact that some of the ones they've invested in will fail and they lose that money.
So they are hedging their bets. So if they've spread their investment across 10 businesses and one of them gives the 10 times return and the other 9 failed, they've not lost. So essentially they just need 1 and a bit out of 10 to survive. The 100x people need 1 and a bit out of 100 to survive or to be staying ahead. So does that mean... I only ever met one person who really benefited. He runs quite a famous business, who really benefited from investment. And he said, don't do it. He said, it's like you start your own business to be your own boss, and then you've got a boss. Like, and like you're saying, they install a board, and now the board are like making sure you're there
Hmm.
from 9 till 5 every day and not out surfing or whatever. Um,
But it depends what you want that business for, though, doesn't it? So if you want to build a business that you are going to keep for a long time and it's going to be your livelihood for a long time, then no, investment's probably not right for you because you want that autonomy long term. If
yes,
you're looking at it as a really exciting, high pressure ride towards some personal wealth creation,
yeah,
then you probably don't care if you've got a board coming in and investors who have a say because you're only intending to do it for 5 or 8 years. It's not the rest of your life that you're signing up to.
yes. And I suppose the danger is that you fall between those two stools and you end up with a board now for the next 40 years because you thought it was going to be a wild and exciting ride. Now it's just a job.
Yeah, I mean, there's always a chance that can happen, and you can always end up building what you think is a lifestyle business, and then it takes on a life of its own, and gets so big that you do need a board and you do need formal audits and all of those kind of things, and suddenly you're like, oh my god, how did I get here? But not without conscious thought is how you got there. You decided to build it that big. You could have kept it small enough to not have to bring in those kinds of people.
Yes, exactly. Do you know Barnaby Winter?
No.
No. Okay. So I talk to everyone about Barnaby Winter like they should know Barnaby Winter. He's a brilliant brand guy. Like you're the 51st person I've spoken to in this series. But this is the 52nd episode because he's the only person who's been here twice. He is a brilliant brand guy. Like any household name you can imagine, he was involved in making them a household name. Basically, he's
Mm.
absolutely brilliant. But he says, I say to people, if you're going to run your own business, really the only benefit to running your own business is if at the end of the day, whenever you decide you don't want to be involved anymore, somebody will come along and write you a big fat check for it. Because otherwise, you might as well take the pension and the holidays and the car and the computer and all of the other stuff that comes with having a job, and the boss, I suppose, of having a job, because it's really not easy running your own business. Now, I said this to Barnaby, and he said, no, it never happens. People never sell their businesses. Like, essentially, he was saying every business was a lifestyle business. But clearly, you're in a world where that isn't true at all. Like, people are deliberately starting a business and looking to sell it within
Mm.
5 to 8 years. So, how common is that? I'm wondering. Like, what percentage of businesses are on the mission that the industry that you're involved in, which is coming up with a great idea, finding an initial investment and more investment, more investment, more investment until you can sell out and be done. Like, it's a stupid question. I know you can possibly have any idea, but is this like 10% of businesses or 20% of businesses or?
I would expect it's probably in the 10% or under, because you've got to remember that something like 60 to 70%, if not higher, of all businesses in the UK only have one person in them.
Yes.
So, so, so there's the large majority of businesses in the UK are teeny tiny and will never get any bigger, and they are the one person that is a fencer or a builder or a what have you, and it's just them.
Yeah.
So so they're never going to go and raise investment because they haven't set up that kind of company. Then you've got the SME type businesses who maybe are the accounting practices or the lawyers or maybe the hairdressers or something where it's a bit bigger, and they've got a few more people in it. But again, it's kind of there as a job for life type,
Yeah.
creation. So they're never going to go after investment either. So there's only a small proportion, which I would expect is probably less than 10%, that would be doing this very fast growth, international expansion, multi demographic um, journey with their companies. And it
Yes.
takes a particular kind of person to want to do that.
Yeah. Crazy person.
Yeah,
Okay, good.
You've got to be a little bit nuts to want to be a founder of a high growth company, because it is a wild ride.
Good. Now we've got our headline. That's perfect. You've got to be nuts to want to be a founder. I'm glad we got here. Okay, good. And I suppose the thing is kind of projected, because the world's largest companies have been built this way. You know, the Googles, the Facebooks, the Twitters, the Amazons, all of these businesses have come about through this kind of funding and accelerated growth. And
Yeah, I mean, not all. If you look at, trying to think who it is, I think it's not SurveyMonkey, it's another one in that realm.
MailChimp,
They've just Yes, so they've just sold for 500 million. They never
have
took a
they?
penny. They never took a penny of investment.
I didn't know that.
So, but they grew that company really fast. But it was a software company, so it was
Yeah,
easier to grow, because they didn't have to build bricks and mortar and buy assets. They could build it
yeah.
all online. But they never took a penny of investment all the way through that journey, and they've
To,
sold it for 500 million.
to be fair, they did take $10 a month from me for a couple of years while I was building my list. And the first time I tried to send to it, they wrote off
Yeah,
95% of my list. So, you know,
yeah.
that must have helped. That was $240. Good. Okay, good. Wow. What a cool conversation. Thank you so much. Oh, so the question number 3 is your recommendation for people. Like, I think you've given us the ideas, but is there a sentence that you would say to people who are looking to get into this style of business or looking to raise investment for their business?
I would say that you need to be able to objectively view your company
They
as an
can't.
investor would,
They can't. That's impossible.
or get someone to help you who can. That's
Someone like
to
you.
give you that dose of realism of,
Yes.
is that a red flag? Is that a problem? What about that big gap there?
Yes.
You need to clear all those things up before you start going out and talking to real investors.
Okay. And your business is called, if they want to get hold of you, your business is called Spark
Spark
Consultancy.
Consulting. Yeah,
Okay.
Spark Consulting. Yeah.
All right. Good. Fantastic. So there's only 2 points of business remaining. What do you recommend people read?
Um, what do I recommend they read?
Or consume?
Uh,
It doesn't have to be read. Like, books are terribly old-fashioned. What kind of content should people be consuming?
sure. No, books are great. I think one that's been instrumental for me, and I think helps a lot of founders, is Atomic Habits. It's not a new book, but it's by James Clear. And the one sentence that struck me in the first chapter and was kind of a life-changing thought for me was, winners and losers both have the same goals. The only difference between them is the systems and processes that they use to advance towards them. So, that winner or that loser both wanted to win that race, but one of them had a better way of getting there than the other one did.
Yes.
So, as founders of businesses, thinking about, what systems, what processes do you put in place to make your business the most successful it can be, is super important. It's not,
Yes.
everyone wants the big exit and the big sale and everything else, but the difference between the ones who get it and the ones who don't are the ones who can really, make the everyday journey as efficient and effective as possible.
Yes. Is that your 3rd cup of tea now?
No, 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 that's the second one coming back.
Good. All right. So, yeah, because it seems to me like actually this is a completely different gig from the 90% of businesses who start their own business. Like, this is
Yeah.
so from the first step, you're on a completely different journey, and if you
Mm.
don't understand that, then then you're not going to succeed in this way, I would say. Okay, cool.
Mm.
Atomic Habits. I haven't read that. I'm going to read that. And Yeah, I think it's true. Everyone wants to win, but if you believe what people are saying on the internet, like we're living in an age of entitlement. Do you know what I mean? It comes across a little bit when you say these people want 100 times return. Maybe that's the best example, because you're saying they have to hedge their bets. But maybe if they were doing a little bit more diligence and only investing in 10 businesses, but making sure that they were 10 really good businesses, then they wouldn't need to spread their bets to that extent. And they just sound really entitled. Like, I'm going to give you $1, but you better give me $100 back. It's like, that's what's going on. It's about how you invest your time and your energy and your money. And that's what we've established today. Okay, good. Just one book that people should read?
No, I think let me do a quick look at my bookcase for what else stands out. I think the other one that's super useful, particularly if you're trying to stand out as that founder that people want to invest in, then Key Person of Influence by Daniel Priestley is also a great place to start, because that really helps you to think about how you stand up and stand out within your industry.
Good. Do you know why I asked this question? Is because I realised I'd stopped reading and I need lots of reading advice. So I haven't read either of those either. Okay, brilliant. So that brings us then to the very last point of business, which is who are you prepared and who are you able to throw under the bus? So this is about you setting up in an introduction in the way that Ketan introduced us. Who do you think might enjoy or at least endure one of these conversations? How have you enjoyed this conversation? Maybe is the first question.
No, it's been good fun. It's been really interesting. I just caught my cable around my foot. So I think a good person for you to talk to would be a lady called Somi Aryan, who runs a company called FemPeak, which is focused around helping women get financial education and financial growth, and it's also very focused around kind of Web3 and understanding metaverse and all of those kinds of things. So it's really about women in tech and finance,
Fantastic.
and providing a platform for that kind of growth.
Excellent. So that's Somi, SOMI.
Yeah, and then Arian is ARIAN.
Excellent. Okay, cool. So I've got that one. Most people recommend 2 people. Unless they've got 3, of course. No one's going to object if you can recommend 3.
Yeah. Let me just have a quick think. So the other one that might be really interesting, because you're talking, we've talked a lot about fast, high growth companies today, is a previous client of ours, a founder of a company called Neurocore. And they are in one of those companies where you have to educate people on the difference, because they are doing pain relief with no pills. So they're doing pain relief through electronic pulses through your body instead.
Wow.
And it's a very, very different approach. So they are having to educate in advance, lay the tracks ahead of the train to get people to understand what their products are capable of.
Okay.
So their founder, Rick Rowan, would be a really interesting person for you to talk to from that kind of marketing perspective of how you lay the track in front of the train.
Fantastic. Cool. And are you able to set up like a LinkedIn introduction or an email introduction with these people?
Yeah, that's fine. I can do that for both of those. Yeah.
Excellent. You are an absolute star. I've thoroughly enjoyed this conversation. And it's interesting because I don't know anything about this. So it's interesting because I kind of feel like I'd be good at this, like projecting and all this sort of stuff. But I can't be bothered, so it's okay. So it's kind of interesting because I've had kind of some of the things that I've thought. Like, I don't know how I think these. Like, you hear these things. I do know. Like 3 years after I was running my business, I'm like, this is amazing. I've got so many customers. Like, I should franchise and get investors, and it's all going to be amazing. And then people start saying to you, no, you're not very good. Not you're not very good, but you're not in the best style of business, or those kinds of things. That's interesting. You've quashed some of my suppositions and supported others, but it's been fascinating, and I'm sure it'll be useful for anyone if Google, YouTube shines the light on this and they get to hear what you're saying. I'm sure it'll be really useful.
Cool.
Um,
Super.
so what we'll do now is we'll say goodbye for anyone who's watching, and then what I'll do is I'll stop recording and we can say goodbye like normal human beings. So thank
Works
you
for
so
me.
much for your time today.
That's you're welcome. It's been an absolute pleasure.
Thank you very much.